Welcome to This Explainer. We are diving straight into the data today to unpack one of the most distressed yet fascinating turnaround stories in retail right now, Advance Auto Parts. Let's get into it. To set the stage, Advance Auto Parts, or AAP, is an absolute titan in the physical retail space. We're talking about the third largest automotive aftermarket parts retailer in North America. They've got a massive footprint, over 4,300 stores, plus nearly 800 independently owned CarQuest locations. And just to note, following the recent sale of Worldpac, they're operating under one primary segment now. They cater to two crowds, your weekend DIYers and the do-it-for-me professional mechanics. And honestly, those pro mechanics, they are the golden goose. Their purchase frequency and basket sizes are just so much higher. The big takeaway here is that AAP is selling highly non-discretionary stuff. Nobody wakes up on a Tuesday thrilled to go drop cash on a new alternator, but if it breaks, you literally have to buy one. Even in a recession, people might hold off on buying a shiny new car, but they can't put off fixing the daily driver that gets them to work. So, the really wild part of this story is that the broader market is absolutely not the problem for AAP. In fact, this industry is projected to grow about 5% annually, cruising toward a massive $500 billion total addressable market by 2028. AAP is actually riding some incredible structural tailwinds right now. First off, the US vehicle fleet is getting older every year, which naturally just means more stuff breaks and needs fixing. Second, cars today are basically rolling computers. They're infinitely more complex, packed with sensors and advanced tech, which drives up the price tag of every single repair ticket. Third, like we just talked about, owning a car is economically sticky. You gotta have it. And finally, the pro repair market is still surprisingly fragmented, which is a massive consolidation opportunity for the big distributors. With a macro setup this perfect, you have to ask yourself, what on earth went wrong? Well, the core issue is a truly devastating collapse in profitability. Look at these numbers. Back in 2020, Advance Auto Parts was churning out a cool $1 billion in EBITDA. But fast forward to 2023, that profit completely cratered to just $324 million. Operating income basically fell off a cliff, dropping from around $800 million to nearly break even. And here is the kicker. While the rest of the auto parts industry was growing, AAP's revenue actually saw a negative compound annual growth rate from 2015 to 2025. In plain English, the industry pie was getting bigger, but AAP's slice was shrinking every single year while their rivals were eating their lunch. Fiscal year 2025 did mark the start of a bit of a recovery, dragging EBITDA back to an estimated $473 million. But this historical nosedive, that's the absolute center of gravity for our entire analysis today. Which brings us straight to the turnaround thesis. Because earnings collapsed so violently, we're talking EPS plummeting from over $9 in 2021 to less than $1 in 2025, the stock doesn't actually need explosive revenue growth to deliver massive returns. It literally just needs to normalize its margins. For a turnaround investor, this is the holy grail. The bet isn't that AAP is suddenly going to sell millions of extra car batteries. The bet is just that they can sell their current volume profitably again. The math is pretty staggering. For every 100 basis points of operating margin expansion on their $8.5 billion revenue base, they generate roughly $85 million in pure additional operating income. Compared to their currently depressed earnings, that number is an absolute game changer. So let's fast forward to the Q2 FY 2026 earnings update from August 20th. This was a brutal reality check. Just before the report dropped, the stock was hanging out in the mid-50s. Immediately after, it tumbled sharply into the mid-40s intraday on heavy institutional volume. The market's reaction was swift and violent. But to understand why investors panicked and hit the sell button so aggressively, we really have to unpack the very conflicting set of numbers management just handed us. Let's start with the good news, because on the profitability front, the results were actually phenomenal. Q2 adjusted earnings per share came in at $1.03. That is a massive 49% year-over-year jump compared to last year's 69 cents, and it totally blew past the 81-cent Wall Street consensus. Even the GAAP EPS looked great, rocketing from 25 cents up to 90 cents. This is hard proof that the very early stages of their profitability recovery, it's actually working. But then the market looked at the top line. Revenue came in right around $2 billion. That was basically flat year over year and slightly missed Wall Street's $2.04 billion target. And man, the market fiercely punished the stock for this. Why? Because the big institutional players want rock-solid evidence that this turnaround is being driven by actual market share recovery. Wall Street doesn't just want a company that cut costs to look lean. They want a store that mechanics and drivers are actually choosing to walk into over the competition down the street. The whole dynamic is captured perfectly in this one line from the research: earnings growth without meaningful revenue growth. It's such a fascinating mixed bag. On the one hand, it absolutely proves that operating leverage and gross margin recovery are gaining real traction. I mean, management even confidently raised their full year 2026 EPS guidance to a range of 260 to 330, even while keeping their revenue guidance pretty modest. That tells you margin expansion is doing all the heavy lifting right now. But on the flip side, if revenue keeps lagging behind the rest of the industry, well, fundamentally, the turnaround isn't truly complete. So, how do they fix the underlying machine? Management has a very rigid four-step turnaround blueprint they have to hit. Step 1, stabilize the daily operations and stop bleeding market share. Step 2, repair those severely depressed margins. Step 3, generate real, sustainable free cash flow. And Step 4, pay down their elevated debt. The research makes it crystal clear. If management tries to pull off some flashy external acquisition before hitting all four of these milestones, that is a glaring, flashing red flag. If they lose focus on the internal plumbing to go chase a shiny new toy, investors need to run for the hills. It's all about execution and capital discipline right now. And regarding Step 3, generating free cash flow, this is where we run into a massive roadblock. Negative $46 million. That was AP's operating cash flow for all of fiscal year 2025. Yeah, negative. Now, management is aiming for about $100 million in free cash flow for 2026. But guys, for a company bringing in $8.6 billion in revenue, running thousands of physical stores, and carrying a heavy debt load, $100 million in free cash flow is just incredibly weak. This anemic cash conversion is the number one reason AP does not, and honestly should not, command a premium valuation right now. To fix these deep-seated operational flaws, AAP is literally ripping out and replacing its entire logistics strategy. Their old setup was painfully underinvested compared to their rivals. They relied on the sluggish network of 38 oversized distribution centers. The new game plan? Build out larger, highly efficient regional market hubs, drastically slash the total number of distribution centers, and get way smarter about where inventory actually sits. Why is this a game changer? Picture a pro mechanic with a customer's car torn apart on the left. They do not care who sells the cheapest water pump. They care who can deliver that exact water pump in under 30 minutes, so they can get the car out and pull a next paying job into the bay. In this industry, part availability is your best competitive weapon. If AEP can nail the supply chain overhaul, it's their best shot at winning back those highly lucrative pro mechanics. Now, when you line ATP up against best-in-class heavyweights like AutoZone and O'Reilly, the contrast is pretty brutal. The peers are flexing 5-star margins, pristine balance sheets, and wildly sophisticated supply chains. ATP, meanwhile, is sitting at a dismal 2-star rating for margins and cash flow. Because of that gap, O'Reilly trades at roughly 21 times EV to EBITDA, which is basically just a metric showing how expensive a stock is compared to the cash it generates. ATP, it's sitting at a massive discount, trading around 6 to 7 times. Let's be real, ADP is a much weaker business today, but because the bar is set so incredibly low right now and the stock is so cheap, the turnaround upside is huge if management can just get the business back to average. You are buying the turnaround potential here, absolutely not the current business quality. But, and this is a massive but, that upside carries some serious execution risk. AAP could literally execute their internal recovery plan perfectly and still lose market share if AutoZone and O'Reilly just out-hustle them. Plus, if AEP's margin recovery hits a brick wall at around 3 to 4% and they can't push it any higher, this stock becomes a literal value trap. A value trap is a stock that looks ridiculously cheap on paper, sucks you in, and then stays cheap forever because the core business is fundamentally broken. Throw in chronically weak free cash flow, higher debt than their peers, and the looming threat of tariffs on imported auto parts, and you've got a very spicy risk profile. Oh, and long term, the whole sector is facing the EV transition. Electric cars just don't need oil changes or spark plugs. Though, to be fair, they still burn through tires, brakes, and suspensions like crazy. So let's get into the final valuation verdict. Because their recent operational collapse makes trailing earnings look so distorted, traditional PE ratios are basically useless here. Instead, we are looking at a discounted cash flow valuation. That's just a fancy way of saying we're projecting out all the cash the business will realistically generate over its lifetime and figuring out what that cash is worth today. After the recent earnings sell-off, the stock is sitting right around $45 a share. We have to figure out if the asymmetrical risk to reward at this exact entry point is worth all the execution risks we just talked about. We always have to quantify the downside first. In the bear case scenario, let's say revenue stays flat or shrinks, the margin recovery completely stalls out at around 3.5 to 4%, and free cash flow stays chronically weak. Under that gloomy scenario, the fair value drops to between $30 and $35 a share. From where it sits today at $45, you're looking at a 29% drop, or roughly a negative 8 to 12% annualized return. Make no mistake about it, eating a double-digit loss is a harsh punishment for a failed turnaround, which proves this is absolutely not a risk-free bet. Now, let's look at the base case. Say management pulls off a modest 2 to 3% revenue growth, they stabilize their market share, and they push operating margins back to a totally normal 5%. Suddenly, the fair value jumps to between $62 and $68 per share. This assumes they can generate around $250 to $350 million in free cash flow. And keep in mind, a 5% margin isn't some wild pie-in-the-sky dream. It's literally just returning the business to how it operated a few years ago. If they pull this off, you'd be looking at a very solid 10 to 15% annualized return from today's price. But if we look at the bull case, the upside is explosive. If those new regional market hubs actually work and drive pro sales, gross margins crack 46%, and operating margins stretch up to 6 or 7%. The math goes crazy. If AAP can spit out $700 million in EBITDA and over $400 million in free cash flow, the fair value rockets all the way to $80 to $90 a share. We're talking about an 89% upside from the mid-40s, offering a 20 to 25% plus annualized return. Having that kind of upside to downside ratio, like a 3-to-1 reward to risk setup, is exactly why distressed value investors are circling this stock right now. Given the intense volatility, the research outlines a very specific playbook for getting in. Whatever you do, don't just dump a lump sum in today. The post-earnings collapse is actually a gift. It gives you a chance to build a position slowly using dollar cost averaging. The first accumulation zone is right here, between $42 and $46. A second, much more attractive zone is lower, down between $38 and $42. And this is crucial. To protect yourself from the massive execution risks we just hammered home, even the most aggressive investors should hard cap this position at 3 to 5% of their total portfolio. Seriously, don't try to make this a 10% hero trade. The entire analysis wraps up with this exact verdict from the research. Buy for patient turnaround investors, accumulate gradually, and demand quarterly evidence that margin recovery is converting into real cash flow. You've got to watch their comparable store sales, their gross margin, and most importantly, that free cash flow every single quarter. And hey, if you see the stock hit technical oversold levels on a chart, remember the golden rule of turnaround investing. Just because it's oversold doesn't mean it's undervalued. You have to let the fundamentals dictate your entry. Which leaves us with the ultimate question to close out this explainer. Can AAP's management actually pull off the rest of this turnaround? Or is this just going to be another brutal value trap? The margin expansion is showing real signs of life, sure, but until they prove they can grow top-line revenue and generate enough cash to pay down that debt, the tension is sky high. It is a brilliant high-risk, high-reward puzzle. In the next few quarters, they won't just dictate the stock price. They're going to prove whether this company has a long-term future at all. Thanks for diving deep into the data with us today.